I could figure out when I was 10, if I had a fairly long life, I was going to end up with a lot of money. I was scared. I was scared stiff. There were a lot of people that wanted us to go out of business over that weekend, and I didn't know what was going to happen.
$5 a day, $1,825 a year, compounded for 40 years at the historical total return of the S&P 500, $947,611. That is not a marketing pitch. That is the exact mathematical output of the future value of an ordinary annuity formula at a precisely calibrated rate. Out of that $947,000 terminal portfolio, the investor contributes only $73,000. $874,611 is generated passively by the geometric expansion of capital the investor never touches. Buffett has called this the foundational idea of his entire 70-year career, and yet the average American investor will never come close to capturing it. Today, I'll show you the exact math, the precise rate that produces it, the Buffett philosophy that mirrors it, the case studies that prove it, and the 3 risks that destroy it. Here is what you need to understand. We begin with the equation itself. The future value of an ordinary annuity formula is FV equals PMT times the quantity 1 plus R, raised to the n minus 1, divided by R. PMT is your periodic payment. R is your annualized rate. N is years. Set PMT to $1,825 a year, set N to 40 years, and solve for the rate that produces $947,611. The answer is 10.5836%. That figure is not arbitrary. It aligns almost perfectly with the long-term nominal total return of the S&P 500, with all dividends reinvested, going back to 1928 according to the Damodaran historical dataset at NYU Stern. The exact rate that turns $5 a day into $947,000 over 40 years is the actual long-run return of the American stock market. But here is what the formula does not tell you. For the first 7 years, your portfolio is almost entirely funded by your own contributions. At the end of year 7, the balance sits at $17,619. In year 8, that capital base generates $1,864 in passive returns, and for the first time, the capital exceeds the labor. By year 30, annual passive growth exceeds $33,000. By year 40, the portfolio is generating over $90,000 in a single year, while your contribution stays fixed at $1,825. The first 30 years exist to set up the parabolic growth of the final decade. That is the part nobody understands until they live it. Now anchor this in Buffett's documented philosophy. The math you just saw is the theoretical spine of his entire career. Biographer Alice Schroeder captured the origin in the snowball. Recalling an epiphany from his youth on a simple table of compound interest, Buffett described the visceral impact, the way that numbers exploded as they compounded. What could be better than that? He expanded it into a corporate framework that becomes a compounding machine. If you could put $100 million into a business that earns 20% on that capital, $20 million, ideally it would be able to earn 20% on $120 million the following year and on $144 million the following year, and so on. Buffett's track record is the extreme upper tail execution of this principle. Between 1965 and 2024, Berkshire Hathaway delivered a compound annual gain of 19.8%, nearly double the S&P's 10.4% over the same period. Let me give you the terminal numbers. $1,000 invested in the S&P 500 at the start of 1965 compounded into approximately $455,000 by the end of 2024. The same $1,000 invested in Berkshire Hathaway compounded into roughly $61.3 million. But here is the unexpected part. Despite his unparalleled capacity for security analysis, Buffett's advice to ordinary investors rejects active stock picking. In his 2013 shareholder letter, my advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. He proved it in his 2007 bet against protege partners. $1 million wagered that an S&P index fund would beat a basket of hedge funds over 10 years. Buffett won definitively. The historical 10% return is a smoothed average. It does not arrive smoothly. The lost decade from January 2000 through December 2009 produced a nominal annualized return of negative 0.95%. Between 1929 and 1943, there was a 14-year stretch where cumulative returns stayed stubbornly negative. The 1973 to 1974 stagflation shock produced back-to-back returns of negative 14.66% and negative 26.47%. The 2008 financial crisis, negative 37% in a single year. The 2022 rate shock, negative 18.1%. A 40-year investor must survive every one of these. Here is the strategic insight almost nobody internalizes. Because you are continuously buying through dollar cost averaging, every brutal drawdown actually accelerates your wealth accumulation. During a crash, your fixed $1,825 contribution buys a larger quantity of index shares at depressed valuations. The crash is not the enemy. The crash is the engine. If the math is bulletproof, why does almost nobody achieve the terminal value? The answer is psychological pathology, not a quantitative problem. Behavioral economists Richard Thaler and Dan Ariely documented hyperbolic discounting, the systematic human tendency to place an irrational premium on immediate gratification while discounting distant future rewards. Charlie Munger framed it as the boredom problem. The big money is not in the buying and the selling, but in the waiting. Dalbar measures the behavior gap every year. In 2024 to 2025, the S&P 500 returned 25.02%. The average equity fund investor captured 16.54%, an 8.48 percentage point gap. Investors panic sold near bottoms and bought back near tops. Munger summarized it. The first rule of compounding is to never interrupt it unnecessarily. Now the practical question. Where do you find $5 a day? You are not deprivation farming. You are auditing the periphery of your spending for microtransactions that fall below the threshold of financial pain. One specialty coffee a day. A streaming stack. One restaurant occurrence a week. The annual $1,825 requirement is recoverable from almost any household budget. Channel that $5 a day into a tax-advantaged vehicle. The 2026 IRS contribution limit for an individual retirement account is $7,500. Your $1,825 requirement consumes less than 25% of that limit. Run it through a Roth IRA, and the entire terminal balance is withdrawn tax-free. If your employer offers a 100% match on the first 3 to 5% of contributions, you only need to source $2.50 a day from your paycheck. Now the inflation conversation. $947,000 nominal dollars in 2066 is not the same in today's purchasing power. At 2.5% annualized inflation over 40 years, the real purchasing power discounts to $353,712. At 3%, $290,495. At 4%, $197,379. Even at 4% sustained inflation, real purchasing power vastly eclipses the $73,000 nominal contribution. Equities structurally outpace inflation over long durations. Corporations have pricing power. They pass input costs to consumers. The strategy is self-hedging. Now the fee trap. The recommended low-cost vehicles in 2026, Fidelity FXAIX at 0.015% expense ratio, SPDR SPLG at 0.02%, Vanguard VOO at 0.03%, BlackRock IVV at 0.03%. Now imagine you place your $1,825 annually into an actively managed mutual fund that exactly matches the S&P. But the fund charges a 1% annual management fee. Your net return drops to 9.5836%. Over 40 years, that 1% fee reduces your terminal portfolio from $947,611 to $721,117. The active manager took zero principal risk and merely tracked the market, but extracted over $226,000 of your wealth. Now to the honest counterargument. In May 2026, the Buffett indicator, total U.S. market cap divided by GDP, sits at 228%, 28 points above the threshold Buffett himself called playing with fire. The Shiller Cape sits at historically prohibitive levels. GMO's 7-year forecast projects negative 2.7% real annualized for U.S. large cap. Goldman's David Kostin modeled 3% nominal annualized for the next decade. Hussman has forecast extended periods where returns fall below risk-free treasury yields. If they are correct, and the golden era of 10% compounding is dead, here is how the strategy fares under duress. Drop the rate to 7.9% over the next 40 years. the math still produces a terminal value of $464,000. 40 years of time overcomes the drag of a depressed rate. Now 3 case studies. People most Americans would have called unremarkable. Anne Scheiber. Retired in 1944 on a $3,150 annual pension from the IRS. Lived in a rent-controlled Manhattan apartment. Invested a $5,000 nest egg into high-quality dividend-paying stocks and never sold. By her death in January 1995 at age 101, that $5,000 had compounded into $22 million. She left it all to Yeshiva University. Ronald Reed. A gas station mechanic and part-time janitor at a J.C. Penney in Vermont, drove a second-hand Toyota Yaris, held his coat together with safety pins, channeled his discretionary income into blue-chip dividend stocks, and held them for life. When he died in 2014 at age 92, his estate was worth over $8 million. Grace Groner. In 1935, a secretary at Abbott Laboratories. She bought 3 shares of company stock for $180. Lived in a 1-bedroom cottage. Reinvested every dividend for 75 years. When she died in 2010 at age 100, those 3 shares had compounded into over 100,000 shares worth $7.2 million. The thread is identical. Time. Continuous dividend reinvestment. Zero panic selling. None had Wall Street connections. None had inside information. They simply had patience almost no one else possessed. Here is your 3-step takeaway. First, recognize the system. The rate that turns $5 a day into $947,000 over 40 years is the long-run total return of the S&P 500. Out of that $947,000, only $73,000 is your contribution. The rest is passive geometric compounding. This is not a strategy. It is mathematics that has worked for 100 years. Second, examine your portfolio. Are you in low-cost index funds, FXAIX at 1.5 basis points, VOO at 3, or are you paying a 1% management fee that quietly extracts $226,000 from your 40-year terminal value? Are you using a Roth IRA to shield the growth from tax drag? Third, build optionality. Even at a depressed 7.9% forward return, the math still produces $464,000. The single biggest threat is not the rate. It is your behavior during the next 37% drawdown. Munger gave you the rule. Never interrupt the compounding unnecessarily. If you want to see exactly which low-cost vehicles match the historical compounding rate, which Roth IRA structures the tax-advantaged version, and which behavioral guardrails the case studies used, that information is widely published. The math is not hidden. The patience is what is rare. I am not a financial advisor. This video is for educational purposes only and is not personalized financial, tax, or investment advice. Past performance does not guarantee future results. The strategies discussed carry significant risk, including loss of principal. Always consult a qualified professional.